coins, tokenized assets, and DeFi vaults. Towards the end, we're going to be touching more on a very light framework on how these institutions are doing to bring on-chain all of these products. So before we start, we like to touch on several Centaur updates. The first one is the milestone of our Kraken vaults crossing more than 500 million in deposits. We are really close to 600 million. And yeah, so far the growth has been incredible. Nowadays, it's not only about the AUM, but also the amount of unique depositors that are counting over 70K. So yeah, we started back in April 2026, and here you can see a chart of the different vaults that we are creating for Kraken. 3 on USDC with advanced strategies, boosted and balanced one, depending on the risk profile. And then the main one that we have for BTC with advanced strategies. The second update is the launch today of our vaults into the Stellar blockchain. So this is our first iteration with the Stellar. These vaults are accessible right now from the Stellar DeFi Hub, which is operated by Ultrastellar. There will be an integration with yields.xyz soon. And yeah, we have seen a tremendous growth with Centaur DeFi TVL ecosystem with more than 200% year over year since they introduced the smart contract. The real world asset market cap on the Stellar blockchain has exploded. Nowadays, there are more than 3 billion present there, not even including the stablecoins. So yeah, excited to share with all of you this launch. So we can say now that finally on-chain yield is a financial infrastructure. Initially, this began as a complement for more crypto-native institutions, exchanges, for example, that were offering staking programs. They started to complement it with some kind of firm programs that in many cases were not really on-chain. Now we can say that really exchanges, brokerages, payroll platforms, and of course wallets have been integrating these programs. So there are some key data points that are validating these, particularly stablecoin transfers have crossed more than 33 trillion in 2025. That's more than Visa and MasterCard combined. And this is a dynamic that is repeating for the second year in a row. Tokenized assets are exploding as well, more than 30 billion in distributed value. This doesn't mean that it's being used in the blockchain as a ledger or a distributed database. It's really value on assets that can be transferred in these blockchains. And probably on-chain yield, the largest vault, the best example would be these Kraken DeFi vaults that we are creating with over 500 million in deposits. So for those that don't know about Centaur, we usually say the institutional DeFi layer. We formed in 2025 from the merger of Into a Block as Trident, as you might know. And nowadays, we are operating as a non-custodial risk manager and vault curator in several DeFi platforms. Some of the largest partnerships that we have announced recently, as mentioned, the Kraken DeFi vaults, a vault with the global payroll company, DL. We are creating the vault behind their stablecoin, DLUSD, integrating to their wallet. Ripple with RLUSD, creating on Morpho, on Euler as well. PayPal PyUSD with vaults creating to Morpho, Camino, and Euler. And also, for example, Fireblock CERN, where we are creating a vault for more than 2,000 institutional clients. So overall, TBL on DeFi Llama is showing plus 2 billion, an incredible pace since October last year, with more than 3 billion deployed. Risk models in production are counting more than 1,000, support for more than 60 different blue chip protocols, and coverage over more than 16 blockchains. So in terms of the agenda, what we are going to be covering today first is just touching a bit on the market data and the macro context that we are currently on, we will explain the earn stack, who is shipping what, and a couple of success stories on our side. We will touch on a very lean framework for those institutions, fintech companies that are evaluating to integrate some of these solutions. Of course, we think that risk is first on all of these programs, so we will be touching a bit on different categories that we are evaluating for measuring real risk on DeFi, with some examples of stress events. And lastly, of course, distribution and go-to-market. We will touch on how these models are working, a bit on the economics, and some guidelines in how these launches can be done in a phased way. So the headline maybe is that the market moved first. Finally, the infrastructure that has been built on DeFi, on blockchain over all of these years has become mature enough for these products to be deployed to thousands, if not millions of people. Probably the first point is stablecoins, which are being used as a settlement layer. Total supply has been increasing plus 30% since January, over 300 billion nowadays, record highs, of course. Monthly settlements, they are at about 7 trillion. So it's the first month that they are above the US ACH network. In terms of which stablecoins are championing, still there is a large advantage on USDT and USDC that are close to 90% of the share. And we are seeing that there are large flows outside of the US, with Asia leading in 2025, for example. So yeah, stablecoin payments have been reaching more than 200 billion in 2025, with a massive increase of about 8x. Visa settlements with stablecoins hitting 7 billion, and some measurement of retail transfers, which sometimes are very valuable to understand as well, is that for those transfers under $250, we have been counting the last 30 days more than 132 million transactions. So you can see how this has been looking since 2020 in terms of growth of the supply of stablecoins, with Tether and USDC dominating, but still several others, very interesting ones that are a little bit behind. Second point is that there is a structural gap between the yields that are being distributed in the average US saving account and the yields that are being offered between different fintech companies, between different yield-bearing stablecoins, between lending markets on DeFi, or some of the stablecoin curated vaults. So we can see how there is a large gap where the average US saving account is paying roughly half a point, in some cases maybe up to 1%. And as soon as we start to have access to fintechs like Robinhood with the gold cash rate, they are offering 3.3. In DeFi, it's not so rare to find yields that are in blue chip protocols ranging from 4 to 5%, and in some vaults with a very contained risk exposure, still is even in the current state, it's not weird to see rates that are oscillating from 6 to 8%. Interestingly, the Federal Reserve is projecting that there could be a migration into stablecoins of more than 1 trillion bank deposits. And we think that these and product definitely are a differentiation feature that can aid for that migration. So speaking of yield, one of the fastest growing segments are yield-bearing stablecoins. It's a type of stablecoin that has been growing massively. So just a year from now, it was about 1.5 billion. Nowadays, it's plus 11 billion. They have been distributing more than 250 million in yield, and this is across more than 100 chains and more than almost close to 500 different applications. Probably the leader in this category is Sky with their USDS stablecoin. Their yield-bearing stablecoin is USDS is at close to 5 billion and currently is paying 3.6%. So we can see how the growth is really concentrating in this earned layer, and maybe touching a bit on regulation. Also, the Genius Act that bars stablecoin issuers to pay direct interest is helping to move that earned stack towards the iteration of these lending vaults that are accessing directly into DeFi. So we cannot continue without, of course, talking about real-world assets. Tokenized assets have grossed 30 billion. This is excluding stablecoins. There are about 700K holders, and there are more than 36 different blockchains that are issuing these tokenized assets. The leaders in terms of category are tokenized US treasuries with BIDL and USIC that are trading roughly at about 2 to 3 billion each. Closely followed after are tokenized private credit that has been seeing a very large growth. And then there is tokenized stocks that we are predicting that could grow massively as well. On this one particularly, I think it's interesting. Just last week, when Securitize was listed in the NYSE, it created a new structure where some eligible investor could hold tokenized equities of their stock, either on Solana or the Avalanche blockchain. And this is not a governance DeFi niche token. It's really a real token with a legal share and voting rights, and of course, being able to receive dividends. So it's super interesting that switch. There are other companies as well that are trying the same structure. Forecasts are clustering, let's say, for 2030. McKinsey, BCG are predicting 2 trillion to 10 trillion on tokenized assets. Standard Charter is targeting about 30 trillion by 2034. And so far, the growth charts that we have been seeing on tokenized assets has been tremendous. So, might be bullish predictions, but definitely at some point we'll get there. We could also say in terms of market data that probably customers were ready for this before the providers were. So from some data we have been gathering, there are about 67 million adults in the US that are holding digital assets. 76% of them would like to access to them through their primary bank. And there is a very large ownership across the Gen Z at more than 50%, which is one of the core demographics on fintech. And to show a bit of the adoption there, we mentioned Kraken Earn, but also Coinbase with more than 2 billion in crypto-backed loans that are being routed through Morpho. Is another good example. Trust Wallet with more than 50 million deposit in the first month of their integration. Telegram Wallet with making available Morpho vaults for more than 100 million users are good examples that there is really demand for this across holders of digital assets. Couple of years ago, we were already saying that institutions were coming, but now I think it's safe to say that institutions are deploying. So here are some examples. For example, Visa has seen 7 billion in settlements in stablecoins, which has been doubling since November. Stripe acquired Bridge for 1.1 billion and has been building the Tempo blockchain and a payments protocol on top of it. MasterCard did a huge acquisition of BVNK. JP Morgan has been continuing with Kinexys, their private blockchain with more than 4 trillion cumulative transfer and seeing 7 billion daily. US banks has been doing a conglomerate to have a tokenized deposit network as well. Something maybe more niche but super interesting is that some other regulated banks like Societe Generale is accessing DeFi protocols directly, for example, with Morpho, with MiCA compliant stablecoins like USCB and USDCB. So getting engaged directly into the DeFi rails. And lastly, the OpenUSD, which is a new stablecoin that is launching from several founding members like Stripe, Visa, MasterCard, Coinbase, or BlackRock. So it's targeting to be a new open low-cost stablecoin and trying to rival Tether and Circle. So we could say that fintech is at the front and DeFi is at the back. And speaking of DeFi, we think that there are three key integrations that are making these earn integrations possible. Probably the first one is speaking of vaults, is Morpho. We have seen how they have been more than 10 billion in deposits. They are powering earn programs for Coinbase, for Kraken, and with Deal. But it's not the only piece in the stack. There are others like vault providers such as Vida that they are providing these vaults that are catering to the ERC 4626 standard that really allows to manage the day-to-day administration of these vaults. Another key player is Merkle, which is playing a role in the distribution of incentives through different programs on chain. So there are some others that are also helping, like, of course, curators play a key role, and we'll speak more about that. Dependencies like oracles, of course. Assets like stablecoins or real assets are part of the stack as well. But to give a quick view into which are the on-chain earn programs that we could see nowadays in production, there are some that are crypto native and some others that we are tagging as more mainstream or fintech platforms. So starting with the crypto native, Kraken with DeFi Earn offering more than 8% APY, with Centura Balls, with Vida, depositing into Aave, into Morpho, and Sky. Coinbase with USDC lending on Aave, and Morpho bots created by Stakehouse. Trust Wallet, so they have another earn program that's more than 50 million in month one. Telegram Wallet, as we mentioned, with direct Morpho yields deposits for more than 100 million users. Others like Gemini, Ledger, or BitGet have already live Morpho and integrations. And Safe, the wallet, is also offering yield in stablecoins, Euro stablecoins through Societe Generale, as mentioned before. And if we take a look at the more fintech mainstream platforms, we can see Robinhood offering a 7% yield on USDG, on Morpho Bolts that were just launched this July. Deal with DLUSD, their stablecoin, integrated into their wallet through rewards. We have PayPal with PyUSD rewards, with Centura Bolts, Revolut, that are also have in place a Morpho partnership. Raise, another payroll company that has built an integration into Aave for Earn. And as mentioned, so they general with their Morpho Bolts on stable coins. So as we can see, on-chain yields, when they are offered through platforms that have an UX that users are familiar with, applications that are compliant, is really the way that we have seen the largest adoption. In terms of case study, we wanted to touch on Kraken Earn and how we have been making possible to scale up to 500 million. So everything started from an app that had already a large use base. The idea was to allow for those users that have been using Kraken and their app without having to manage any kind of seed phrases, to just have access to an earn program through there. So that's the first distribution point. Then there is a conversion phase where the whole program needs to convert the deposits into stablecoins, into USDC, and be deposited into a vault that is managed by a vault provider like Vida. And then there is a set of different risk tiers. Users can pick, in the case of Kraken, between balanced, boosted, and advanced strategies for stablecoins. So depending on the pick that they do, the yield can vary, as well as the withdrawal terms. So those are stated up front, and depending, most of them, like the ones that have the more modest yield, they have instant withdrawals, and the ones that are accessing to advanced strategies, they usually have a 1-day deallocation window. And this has been without relying on token incentives from Kraken, and the yield so far has been really, really sustainable, considering the scale that it has been growing. So we can see on the right the yield since they were launched for the stablecoin vaults, balance, boost, and advanced strategies. And we can see how, despite of the growth, yield has remained certainly volatile, certainly stable. It's true there is some volatility, and this is due to where the yield is coming from. So the yield in these cases are coming mostly from borrowing demand. So lending protocols where they have already markets where there are users willing to deposit crypto collateral like wrap BTCs, EBTC, ETH, wrap stake ETH. They are willing to borrow stablecoins and pay a borrowing fee for it. So demand can really oscillate. There can be, depending on the market sentiment, some withdrawals, and hence why it can spike the rate. But the drawdowns are really minimized, and if we average the yield, it has remained very, very stable. The key differentiation here is the risk layer, right? So making sure that there is always enough idle liquidity, so users that have deposited large amounts can withdraw at any point has been critical. Of course, on Centaura, if you have attended to our webinars, we have been speaking largely about the risk modeling that we deploy into production. So making sure that there is a risk monitoring in real time with several parameters that are being checked constantly. Things like utilization rates, different Oracle updates, rate oscillations. If you really want to take a look at how part of the risk engine is looking, you can access to our risk radar, defirisk.centura.com, to see a sample of some of the signals that we are using for risk monitoring. So this is mostly a look at how the integration is looking for users that are accessing through the app. They can see the DeFi program paying 8%, up to 8% for stablecoins. And on the right, there is the menu of the different strategies that are provided. So ranging from advanced strategies with 8% to high yield to 4% and balance with 3%. The second case study is with Deal, the global payroll company. So it's been super interesting because it's been reaching initially 1.5 million users, has been rolling through LATAM, APAC, MENA, and Africa. And they are targeting rewards up to 4%. To see really the stack into understand which are the different layers that has been making this possible is first on the issuance side with the LUSD stablecoin through Bridge. Then there is the wallet component that has been used in Privy for embed wallets, which means that there is no need of seed phrases, so makes custody for retail users really easier. The yield component is bought through a Morpho Vault that is being created by Centora and deployed in the Tempo blockchain, and lastly relying on oracles from Chainlink and Redstone. So as we can see, the key here is that the blockchain mechanics are really abstracted away from the final users, and they can just access in a front end in an app that they are familiar with, and makes it easier to use. Here you can see a sample of how the deal app is looking with their program. So touching on some framework to evaluate these integrations, probably one of the first picks for these fintechs is to engage with some of the different lending protocols that are available. There are several parameters that we need to check before starting to evaluate these different integrations. So the first one is security, of course. Things that really matter are the quality of the auditories on the smart contracts and infrastructure that they have, how many, which are the entities that have reviewed those smart contracts or infrastructure, any live bug bounties, formal verification is a plus nowadays, track record and loss history are really important. Here is interesting to see, for example, the Euler exploit on 2023 that cost close to 200 million, but we recovered. And the same protocol nowadays with a V2 version has more than 60 different security reviews. I think it's the protocol that has been reviewed the most technically and is still working perfectly. Composability is key. So there is the ERC 4626 standard, which is how most vaults are relying to. There is the liquidity quality. So it's really key for users to be able to withdraw their assets when they want, to have some sort of idle buffers, that the underlying protocols offer these kind of features, usually controlled by a curator, but in some other cases it's just embedded into the protocol. Touching on liquidity, there is also the governance and decentralization part. So it's really important to understand who can change the different risk parameters of these lending protocols, to understand who is capable of including new assets that might be more or less risky. So those need to be studied upfront and evaluated. Lastly, the upgradability. Not always immutable contracts are better. There are pros and cons to both approaches, immutable or upgradable. But usually we can say that upgradable contracts require to rely to give more trust to the provider that is upgrading those contracts. The best way to understand these differences maybe is speaking of the four venues, the four lending protocols that worth comparing nowadays. So you will be familiar probably with most of them, but of course Aave, which is the champion here, still is the deepest lending protocol in terms of liquidity. Is governed by a DAO. It has a very solid governance process in terms of tile knocks and guardians. Is very solid. It has plus 27 billions of TVL, more than 1 trillion in cumulative lending volume. But one needs to be aware of the governance processes in case of additions of new collaterals. In the case of IB3, IB4 will work a little bit different, but still you need to trust the whole protocol to some extent. Morpho is immutable, so the governance is very minimized. It's really relying on the curators. So when you trust a vault, you are really trusting the curator and their choices. Things like the oracles that they are picking, the interest rate models, the collaterals that they are being included, different assets. So yeah, it has really a clear separation between curation and the infrastructure that they provide. Spark with their savings vault is really straightforward. Is also governed. They have a dedicated risk council. Is Sparkland is another piece being forked by it's a fork by Aave, and it's also relying on Lars Johnson governance votes. And lastly, there is Euler, probably the more modular approach with isolated markets. Probably the strongest in terms of risk isolation. It's also a little bit more heavy to operate and for users to deposit. But if you really understand, or your creator really understand what they are doing, they can be extremely flexible to create very robust lending markets. So as we see at the end, it's really a choice between governance and control, and of course trust. And we were mentioning about trust and curators. So really, the curator landscape nowadays is like 75% of the AUM is being held by three main curators. The first one is a Steakhouse with 2.2 billion TBL, with key integrations on Coinbase and Robinhood vaults. Centaura, we are at the top two right now, with Kraken, Deal, Ripple, PayPal, or the Fireblocks integration. And third, there is Gauntlet with Aave, Compound, Morpho, and Trust Wallet integrations. Think that really to pick curators, they need to be evaluated in stress events where there is really liquidity drains across DeFi, and is where really shines the risk frameworks that they are being evaluating. Some key things in terms of risk that we look at, for example, there are several others, but just wanted to touch on some of those. So things to really grant, to really pass the checks on a protocol or an asset when we are going to deploy into a new vault that it has exposure to different assets. We are really looking to assets and protocols that have more than 50 million in TBL, that they have a large track record of at least a year. Of course, that they have multiple independent security audits. The governance should really be either immutable, or the key functions that can really change the inner working of these protocols be time locked, so they can be monitored in time. Of course, initially, in terms of the range of assets that we like to have exposure, we only focus on blue chip assets, very large market cap tokens that have been lying for a while. And yeah, so in terms of risk, there are four categories that are key that nowadays we think that everyone should watch on. So the first one is custody and keys. Lately, we have seen how most of the hacks have been focusing on access controls. So key compromises are the ones leading the ranking in terms of crypto losses. So wallet infrastructure, signers, the recovery path are really, really important. Qualified custodians, MPCs are providing these kind of solutions. Multi-sigs with clear signer policies, for example, are key. After custody, we usually focus on code execution and oracles, so anything related to audit coverages, oracle quality, uptime is really, really important. Stablecoins are always in the mix, so we can understand stablecoins as their tokens are liabilities, and their backings are really the reserves that these companies have. So sometimes these reserves can be validated on chain. We can see where they are deployed, where they are held. But in other cases, we are just relying on off-chain processes. In those cases, it's really important to have attestations with a healthy cadence, to really test the redemption mechanics, to make sure that the the withdrawals are really meet the times that are stated in the documentation of these products. Of course, keeping its price stable is given for granted. And yeah, after that, liquidity and redemption path are critical not only for stablecoins but also for some of these lending protocols that are operating under different idle buffers or idle sleeves. In the case of lending protocols, utilization is key. Understanding really if there is any, if there could be any liquidity crisis in a market is important to understand if you are going to be able to withdraw your assets or not. So yeah, in terms of risk monitoring, we think that these are several parameters that can be checked on chain, which means that 40-same monitoring is required. And in many of the strategies that are in our vaults, there is the capability to unwind a strategy automatically. That's based on the leveraging the loan based on the health factor. So these kind of circuit breakers are key to operate positions at scale. Some examples on how these stress events look like. Probably the largest one we could speak about is the USDC DPEG that was trading in 2023 briefly at 0.87 due to the stranded SVB bank. So yeah, we saw that contagion risk to other protocols, other stablecoins as well. More recent one, the one that really moved markets at drain liquidity was the liquidation cascade of October 2025. So more close to 20 million were liquidated. It's the largest ever that we have seen. Yeah, open interest on derivative markets fell 43%. The ones that maybe are we're more used to more often, let's say, are crypto hacks. So they are accounting at about 3.4 billion. It's true that about 40% of it was the Bybit incident. Still, there is a large threat surface related to access control and custody. So this designing infrastructure is really critical. Multi-sigs, MPCs in place is something that is becoming standard in the industry. We have seen a pattern start to change from 2021 to 2023. We saw an increase in hacks, and nowadays, in terms of total numbers and total of hacks, we have seen a decrease. It's true that there is some kind of uptick in the latest year, maybe due to the AI models, we believe. But what is true is that these attacks are really focusing on access controls, on key custody, and those are solutions that are easier to tackle than smart contract logic, for example, which are hacks that are not so often seen nowadays. So in terms of distribution and a bit on the economics, we see that there is probably three ways to ship these kind of firm programs. The first one is the embedded path, which is to embed these programs in an existing app. In many cases, these are favoring mobile apps. Nowadays, we are seeing more and more users that are just accessing financial services through their phones. So yeah, it's the platform, the one that is owning the whole integration. There is another approach, which is the B2B2C through embedded wallets like Privy. This is the path that DL use and has been also really successful. There is also a possibility of a white label infrastructure, so mostly working on a distribution front end, plugging in an ERC 4626 infrastructure, and then relying on a curator for the layer of risk management. In terms of commercials, so the margin is sitting between the spread of the gross on-chain yield that is earned between the strategies and the rate that is passed to the customers. So usually there is a charge on a performance fee that can range from 25 to 15 to 5%, depending on the underlying infrastructure. In some cases, we have seen also a spread on the reserve. So stablecoins can earn interest on the 3 to 4% on idle deposits. So yeah, the reference point for this was Coinbase that on Q1 2025 earned 300 million for the distribution of Circle, which seems to be more than the Circle's net revenue that quarter. So we think that the path forward is probably for this kind of iteration a phase approach. Probably the pilot is just to focus initially on stablecoins, just counting with a very risk conservative vault created by a well-known curator on the space, having cap deposit. And limit at launch probably the accessibility of it in terms like on geographies, have a plain language like disclosures explaining that the rates are variable, that the case that might not be the deposits might not be insured, and really make upfront which are the withdrawal terms. Then we think that rates can really start to scale by adding more assets or different vault tiers. Then there is the component of trust and measuring. Making upfront, displaying upfront, which is the historical rate that these vaults have been earning, explaining which are the buffers in terms of liquidity that are available to withdraw, the latency if there is any for withdrawals, any concentration risk that might exist. And yeah, pretty much all the stack can be contracted nowadays, from custody to vaults to curation, even to coverage, which we will be launching soon, a coverage protocol incubated by Centaura called Firelight. So if you're interested also on it, please check it on socials. And we really think that the differentiation is risk. So of course, returns maybe better set the risk-adjusted returns, and having disclosures upfront that users really understand fully where they are depositing into. Lastly, we are going to launch very soon, probably towards the end of this month, an annual report on fintechs Onchain. So yeah, will be a bit more of a longer report. We will publish it on our socials under our Centaur account. So make sure to follow it on X to get notified about it. Okay, I think we can move on to the Q&A. So feel free to post any questions on the chat. So Diego is asking a good question. How do you see the vault curation space involved with tokenized stocks in the future? We think that they are going to be a key component of it. The capability of earning yield that is not coming, that is coming directly from DeFi, it can really be huge. We have been seeing several integrations of tokenized equities into DeFi, and the borrow rates can be very, very competitive. And there are ways to earn yield on other strategies, on other protocols, probably. So we think that that can be huge for sure. Yoma is asking, how do you think that OpenUSD will change the stablecoins market? It's a hard question, right? I don't currently see, at least on like fully on DeFi, I don't see a straight angle. But yeah, it's probable that maybe they focus on some other fronts that might make them grow larger. But we have seen several attempts at this, and it's really, really hard to disrupt the existing stablecoins, mostly due to the deeper liquidity that they have. But yeah, the consortium is really, really solid, and I'm pretty sure they will have good ideas. What else we got? Yeah, there is some questions on Farlight, so I recommend you all follow on socials. We have been publishing a lot of content explaining how it will work. So not to disclose so much, but yeah, it will be based on coverage for bolts. The approach is a little bit different. It will be integrated as a coverage on existing mainstream bolts. So that's the approach that we are taking. There will be an staking site as well for those that want to earn yields on different coins. But yeah, I recommend you follow on socials for the exact dynamics. Um, and yeah, there are some other comments about fintech requiring risk assessments to operate on DeFi. I think it's really the part of the curator's responsibility doing these integrations without having a curator in the middle that is up to date with and monitoring daily everything that is going on. DeFi is close to impossible. So I will say that it's one of the key components as integration. Diego is asking, how does bot curation protect itself then when tokenization takes over and players like Securitize or TradFi banks create bolts or ETFs around tokenized equities? Uh, I don't really know if I understand the question. They could create bolts around tokenized equities. I guess it will be a bolt per each tokenized equity, since the bolts really need to operate based on a single asset deposit. Um, I don't know. I could see them creating these kind of bolts. They will require a curator to be managing the earn side. So not relying on dividends, but relying on some of the DeFi yield, I think could be super interesting. Definitely doable nowadays, but it's really a matter of distribution and making sure that there are entities that might be interested into earning these yields that might be holding their stocks on brokerages maybe. Okay, let me see if there are any other questions. Federico is asking about the yield bearing stables. What's normally the source of the yield and what are the risks associated with it? So some of them are coming from real world assets, might be tokenized treasuries, might be tokenized credit. In other cases, are coming from more similar activities, more similar to trading, like basis trading with Athena in the past. Another important front is, let's say, private credit with Maple and Syrup USDC, Syrup USDT. Is based on crypto-backed loans, so that's another angle that can work well. Yeah, I think that's all for today. So yeah, hope that you like the webinar.